Good afternoon, good evening, good morning, and good day, wherever you may be watching this. I know we have people around the world who participate, so I hope it's a good day for you. This is Arlan Suderman, Chief Commodities Economist at StoneX, back with you to discuss another report from USDA. Not too many surprises on this report, really only one, but we're going to take the time to break down some of the nuances of the numbers and what they mean, as well as look at some of the other outside factors impacting the markets. And so we've got plenty to talk about. So let's go ahead and get started. I want to make sure and show my compliance slide and have it up there long enough for you to take a look at it. Overall, I think the primary numbers here that we're going to be focused on are going to be the corn stocks number and the implications for that. But there's some other numbers in here too that I think do have some interesting implications. I've been talking too much already today. Price is a function of supply and demand is modified by the flow of money. So let's start with taking a look at money flow. We did get the first rate cut from the Fed in this current cycle on September 18th, as you see here on this graphic. We had plateaued and basically paused the monetary policy as far as rate changes back in July of 2023, and then the Federal Reserve made a 50 basis point rate cut on the 18th. That caught some people by surprise. My personal opinion is that it was too much of a rate cut, that they're being too aggressive, but they didn't ask me, so we'll continue to watch this. I do anticipate that we're going to see a continued downturn near term on headline inflation until we see energy prices turn back higher. We've seen a little bit of a rebound. So as we get the October inflation data, we may see even the September data that we may start seeing a stabilization of it. A lot of the decrease in inflation numbers, the headline numbers, have been because of a commodity deflation mode by the funds, which we've talked about before. I anticipated that would go a little bit longer, but we actually saw from the day that, and I'm going to show you this in a little bit, but we saw the mood of the funds change when the Fed made this 50 basis point rate cut. So it did have an impact, and I'm going to demonstrate that here in a little bit with the graphics. But as we look at the longer term 2-year and 10-year yield curve, for the last 2 years, this has been a poor indicator of recession. Remember when it started getting close to inverting, all the pundits are saying it's a big predictor of recession, and that recession never came. And now that we've gone back the other way with the 10-year trading at a premium to the 2-year, all the pundits are saying that's an indication of recession and that it's imminent. But I just think they're going by the old behaviors of the market and economy when it wasn't as full of fiscal stimulus as it currently is. And I think they're discounting that. As we see the consumer price index here, you see that the headline number continues to turn lower, move lower, and getting closer to that mandate at 2.5%, the mandate at 2%. But look at that headline number. The headline number actually inching slightly, not headline, the core number actually inching slightly higher. The core, of course, doesn't have food and energy in it. The service sectors where we're seeing most of that, shelter costs rebounding already with the lower interest rates that the market already had priced into it, as well as transportation costs. And that's largely due to a big increase in car insurance because car thefts have dramatically increased over the last couple of years as a lot of states going with cashless bail programs or otherwise not really punishing people who steal cars. And so we've seen a huge increase in car thefts, particularly in some states that the insurance companies have to account for with their premiums. Fed really has no control over that. If we look at US GDP, 3% in the last quarter, that's the second quarter of the year. We are today completing the third quarter. So later in October, we'll get our first reading on third quarter GDP. But right now, the modeling is suggesting 2.5% to 3% GDP in the third quarter as well. So not a significant threat there to recession. When you look at the unemployment rate, it did tick lower. Now on Friday, we're going to see this updated. It went from 4.3% to 4.2% last month. If it would happen to read 4.4% then or higher, then we could very easily see a 50 basis point or more rate cut in November, depending on what the November jobs report does, which should come out before the next Fed meeting. But if it's at this level or lower, probably a 25 basis point rate cut based on what the Fed has told us at this point. Now, I'm not going to spend a lot of time on our national debt. I have covered it before, but I do want to keep you engaged in this discussion and keep you updated. If we look at our national debt right now, $35.4 trillion in the upper left-hand corner, and then just to the right of that, you see what our annual tax revenues are of $4.9 trillion. Now below that, I've got a big circle over 4 different spending categories. Medicare, Medicaid is $1.8 trillion. Social Security is just below $1.5 trillion. What we spend for national defense and war efforts is around $930 billion per year. And then what we spend on servicing our debt, $956 billion per year. And this number has just exploded over the past year and a half and higher. Now it's more than what we spend on defense and war. If you add those 4 categories together, that comes to more than it comes to more than $5.1 trillion, just those 4 categories. Well, as I said, right above that, we're looking at tax revenues coming in at $4.9 trillion. So we're already have a deficit with just those 4 spending categories. And we haven't got to the other discretionary spending, or we haven't got to food stamps, ag programs, Homeland Security, food stamps, all of our programs to help the poor, education, police, fire, what the federal government contributes for that. I could go on and the things that aren't even listed yet, and we're borrowing money for all of that now. And that's the state of our national budget. And so when interest rates were near zero, it really wasn't much of a problem. But interest rates are above zero now. And we're rolling putting on over the next 12 months expectations about $9 trillion worth of debt certificates. And as interest rates near term are coming down, or the retail customer, we expect to move more toward the stock market with their money. And we already know that foreign investors are moving money back home. In a lot of cases, it's because they have better opportunities at home. So in other words, our debt market has to have higher yields in order to attract more buyers. I mean, it's just what happened. You increase the supply of debt certificates, you have a decreased demand for it. That decreases the value of the debt certificates, and contrarily, then the yields go up, particularly the medium and longer term. And so what that ends up doing is we continue to expand our debt, is it starts to squeeze out the credit markets, it starts to squeeze GDP and slow economic growth. And that's my concern going forward. This will become an issue again, I anticipate, after the elections, when we have to do something with the debt ceiling before January 1st. So that's going to be a challenge. And eventually what this means, and I notice we have a question on here about this, so I'm going to address it now. We had a question opening up about what this means for agriculture, because we're not addressing this at all to this point. And so what this eventually means is for mid and longer term credit, it means higher interest rates. And that's a higher tax on you. It's a higher tax on all of us as Americans. is those higher interest rates that are necessary, particularly if we see a downgrade in our national credit rating. But even without that, we can see higher interest rates over the longer term because of it. So now let's tie this in all with the commodities. As we look now at the 5-year break-even inflation rate, previously I've been showing you since the meltdown in the stock market around the 1st of August, we broke below that 2.2% basically support line on inflation expectations. But since the Fed cut interest rates by 50 basis points on September 18th, it's been trending higher. Now, that's not a significant move. That's not a breakout of a trend necessarily, but that's something we're going to keep watching. Does the 5-year break-even inflation rate continue to trend higher or not? But look above it, the dark blue line, commodities have definitely broken higher. Now, that's not a significant chart break yet. It's a beginning of a trend, but we'll be watching to see, and we'll update this again when we do our October WASDE report to see if we do have a larger breakout to the high side of both of these items moving simultaneously here with a pretty solid statistical correlation. And when we look at inflation, that's still working lower, as I indicated, but commodities are starting to work their way higher in the near term, and there tends to be a couple month lag or so between commodity prices and inflation. So we'll watch and see if these commodities continue to work their way higher. Looking at it with the grain and oil seeds, you definitely see they're working their way higher. Now, commodities are facing some bearish fundamentals as well. So a lot of it to this point has been short covering. Remember last spring, we had a short covering rally. And that was it, because the fundamentals didn't support going higher. And once those reinflation concerns backed off, then they went short again, and commodities went back down again. So we'll continue to track that. If you look overall, and you can see this little tick right there on the right-hand side, we're looking at the grain and oil seeds and livestock all combined. The funds have gone from basically record short positions to now just a modest short position as they've been unwinding those short positions, despite some bearish fundamentals, particularly for the grain and oil seeds. When you look at our StoneX commodity tracker and separate it by sector, overall you see that the grain and oil seeds, which had been the poorest performing earlier in late summer, this is looking at 1 year performance here. Now they're moving higher. Energy is moving higher as well, but it's still down there pretty weak. What does that do to inflation if those two start moving more dynamically higher is a key question. But obviously you see that the precious metals have done outstanding. And of course, you're probably aware that gold has set new record highs and silver has been following behind. And overall, the softs have performed well, largely led by cocoa, but have done well as well. The strongest statistical correlation that we see between the 5-year break-even inflation rate and the commodities is with industrial metals. And so you can see what they've done here over the past year. I'll talk briefly about China. I just have this one slide on China for this webinar. Because some things just happening near term. Their economic data, which I've shown you time after time in these webinars, it still is pretty bleak. But this past week, we saw China announce a number of different stimulus packages. They didn't give a lot of details, and so the market has responded dramatically. I think their CSI stock index is up by 26% from their mid-September low. One property company that's actually trading in Hong Kong is up some like 60% since their mid-September low. So a tremendous amount of money come in. Now the stock market surge, and China admitted that they felt like one of the keys to turning around consumer sentiment was to turn around the stock market. And so they announced these packages, which were kind of broad-based, lacking detail type of things. And by lacking detail, I'll tell you one thing we've learned is the 50 basis point mortgage rate cut that'll put more money in the pockets of consumers to spend doesn't go into effect until December. But when we get more of these details, will the market be disappointed or won't be encouraged? Now, if the Fed continues to cut rates, we expect China to come out with more stimulus packages, but the market is also pricing that expectation in. If China doesn't, that'll be a disappointment. This money could come out just as quickly. But the surge in the stock market was initiated, as we broke down the details, by state-backed funds. In other words, the government pumping massive amounts of money into the stock market, turning the charts, getting momentum, and then fear of missing out, FOMO as we call it, caused a lot of private money, including foreign money, to come in and continue the upward momentum. It's just how long will it stay there, and will these stimulus packages be enough to live up to those expectations that the market is pricing in? That's going to be part of the key. Simultaneous to that, well, let me also say this. Starting tomorrow, so October 1, lasting through next Monday, October 7th, is the national holiday in China. That's the holiday to celebrate the anniversary of the Communist Party, the Chinese Communist Party, taking control and starting rule in China. So authorities wanted the consumer mood to be better. Consumer mood was pretty dismal coming into these stimulus packages. Tickets, airfare tickets for traveling, event tickets for participating in things during the holiday were down significantly, and even below pre-COVID levels for some things. And so the government knew that they needed to do something prior to everybody coming together and talking, because they wanted a more upbeat attitude, plus they wanted more consumer spending during this holiday. Now, the real key is, do they get that consumer spending? Does it actually result in that? And that's yet to be seen. But the other thing it does is it takes the eyes off of some other factors that have been going on. First of all, China has been doing joint military maneuvers near Japan with Russia. That's significant. They have dramatically been increasing military incursions near Taiwan, with missile firing really intensifying there. And some observers have called that gray zone warfare, or or something to that effect, meaning that it's kind of like in the months leading up to Russia invading Ukraine, they were doing all these activities along the border of Ukraine. And even a matter of days, the week before the February 24th invasion of Ukraine, Ukrainians said, oh, they're not going to invade. They always do that type of thing. They're just trying to scare us. And what the gray zone type of war efforts means is you're kind of getting people used to the incursions. You're softening them up so they're not prepared when it happens. Does that mean that China is going to invade Taiwan? I don't know that we can say that. We don't know the intentions. But if you're going to do it, this would be one of the things that what I want to say that China would probably do. And so that's a black swan event potentially that we need to keep our eyes on for the commodity markets, which I've talked about before. And then this last week, and very little news coverage was seen of this, China launched an ICBM into the high seas of the Pacific last week. And then they boldly announced it. Now, what's significant about that? Because China said, well, this is just part of an annual exercise that we do. And we notified the relevant countries. Well, you would think Japan would be the most relevant country, or one of the most relevant countries, and Japan said they didn't notify us. Maybe they notified Russia. I don't know. But China in the past has regularly tested missiles, usually in the deserts of Western China. And they wouldn't admit to it. They don't talk about it. If we pick it up on satellite or whatever, they don't admit to it. This one they launched into the high seas of Pacific. They haven't had a launch like this since 1980, and they boldly announced it as if they were sending a message to somebody. Were they sending a message to the United States? And if so, why? Are they saying, we're about to do something, stay out? or what? This ICBM had the capability of carrying a nuclear warhead. It did not have a nuclear warhead. It had a dummy warhead. And allegedly, it had the capability of going as far as the mainland United States. So something to keep an eye on going forward as geopolitical risks continue to intensify around China. Weather risks. Okay. If we look at the month of September, the climate district rankings for precipitation, we see that out of 132 years worth of data, central Minnesota, southwest Minnesota, northeast Nebraska saw their driest September on record out of 132 years. Eastern Tennessee, western West Virginia, northwestern North Carolina saw their wettest September on record, and that was largely due to hurricane remnants from Helene that happened, but very wet in the southeast, largely because of Helene, but very dry in much of the rest of the Midwest. And much of the eastern Midwest would have been even drier if not for the rain that came out of the remnants of Helene as well. So a very dry finish to the crop, and that took some of the gravy off of the crop, shall we say, some of the frosting off the cake. So we have very big crops this year, but not as big as they would have been had we finished with more moisture. August started this out dry, and September really intensified it. Now, as we look at temperatures, it's a little different story. The northwestern Midwest had the hottest September on record, but not so much, more closer to average, shall we say, in much of the central and eastern Midwest. So very, very markedly different there, temperature-wise. Not mild, not cool necessarily, but not hot for the month of September. So that would have made it a little easier for the crops to deal with it. But particularly in Indiana, I'm hearing some disappointing yields elsewhere as well, but especially in Indiana, that's what I'm hearing. And so we'll talk more about that, and we'll go into that more tomorrow. By the way, October 1st, we will be coming out with our updated customer yield survey here in the United States, as well as in Brazil. So keep watch for that. If we look at the equatorial Pacific, we see its sea surface temperatures are trending cooler. They're going to ebb and flow, and they actually got into moderate La Nina territory. If I'd update today's data, it would show us back in weak La Nina territory. That's normal, the ebb and flow, until La Nina actually gets a foothold. But more and more, this is becoming what is driving our weather. It's not totally driving it yet, but we're definitely moving in that direction toward it having a greater influence on driving our weather patterns. And so as a result, you can see the anticipated correlations or what we anticipate for the November to March time period with our coldest weather outbreaks in the north and our warmest days in the south. And they're on the left, in our driest weather in the south and in the center part of the country. And overall, this means that we typically see the storm track come in like this and then dive to the northeast. So you get this rain, snow pattern, ice pattern here in the Ohio River Valley. You get a wetter stretch of weather here in the northwestern part of the country. And it doesn't mean there won't be storms here in the middle of the country. It doesn't mean that there won't be periods of cold here in the middle of the country, even reaching down into the south. But overall, this is what the averages are going to be over the longer term if we follow that typical La Nina type pattern. Now, let's look at South America. And I had this in the September WASDE webinar, and I wanted to put it back here again for anyone who may have missed it there, because I think this is a pretty significant chart. Look at what the difference means for different parts of Brazil and Argentina, depending on the strength of La Nina. So if we would stay as a weak La Nina, we'd see center west Brazil. The odds are less than 50% that it'll have a dry summer. And that stays the case really until you get into a strong La Nina type of a setting. Southern Brazil, if we stay weak, you're leaning dry. With a strong La Nina, you're leaning dry. With a moderate La Nina, you're leaning dry. If you stay negative neutral, it could go either way. Argentina, that makes a big difference there. Weak La Nina, much higher odds of being dry. Strong La Nina, 50-50. Moderate La Nina, 40% odds of being dry. Neutral, 50%, either way, could go either way. So it makes a big difference what the strength of this La Nina is. So keep your eyes on that as we go forward, and we will follow this as well. Now, here's today's latest European model for the month of October. So as we look at the next 31 days, this is what the average would be. Right now, it's really dry across most areas, except for it's been really wet in this area here of southern Brazil and parts of Argentina. Center west Brazil is largely in that area right there. And they've been dry, record dryness in a lot of those areas. Now, you see on here that there's a lot of green starting to show up in this area here on this, but confidence remains low in that. It hasn't started yet, and the models have really been flipping back and forth on that. In a typical La Nina year, we do see those rains develop, and those rains do come and start going maybe in the last half of October and really pick up momentum in November and December. But they tend to be drier in southern Brazil, but the higher yields in center west tend to offset the losses in the south. But how will it be this year? Confidence is pretty low. These things keep flip-flopping, but this is the latest model. If this happens, and I'm going to show you the next slide here. Excuse me. This is the map for the next 15 days rainfall. Now, most of this rain here in center west Brazil is in the 11 to 15 day period. So October 10, 11, 12, 13, 14. Most of that rain is in that period. So that's late next week and next weekend, a week, not this coming weekend, but the next one. And if that happens, then I think we'll see very active and rapid planting of the soybean crop. And if the rains continue to come, they can have a normal or better soybean crop, which tends to be typical in La Nina developing year. It does increase risks for the winter corn crop, the safrinha corn crop, if you will. It doesn't guarantee you a short corn crop. I can find years when we planted the corn crop late after a late soybean harvest and still got a big corn crop. But it does increase the odds of a smaller corn crop. So that's something we'll be keeping our eyes on, and I'll keep updating you. I'll update you again when we get the next, when we have the next seminar, on October 11th. Fundamentally, you see here today, USDA gave us these wheat production numbers. And you see that all wheat production came in right exactly where we expected, which is about 5 million bushels above US average trade guess. Winter wheat crop came in very close to the average trade guess, although a little lower, about 8 million bushels less than what I had for total winter wheat. The 770 million bushels for hard red winter wheat that USDA said, that matched our estimate. I'd say our estimate for that was developed by Mike O'Day in our office, who does a good job of kind of breaking things down and studying the class by class. And so I looked at his estimate and I said, I agree with that. That's a good estimate. And then on the soft red winter, this is a typo. That should be 342. So I would see if I can write that in. That's not easy to do with a cursor, folks. So I hit the wrong key with my finger. That's 342, which is exactly what the trade expected and within 1 million of what my estimate was there. White winter at 236 was 8 million less than the trade expected and less than what I expected. Other spring at 542 was just 2 million above what the trade expected and 4 million above my estimate. This is a little bit more of a surprise. Durham at 4 million bushels above what the trade expected and above what I anticipated. If we look at U.S. winter wheat, and these should be the final yield estimates now released today, unless USDA finds more data to update in January in their annual report. But you can see the state-by-state differences from the August production estimates. So in the plains, we generally saw decreased yield in the plains. We saw some increases in the Midwest. You know, for the winter wheat, you kind of see how it comes out, the bushel changes per acre from the August production estimates. We look at spring wheat yield. Well, we saw North Dakota up 3 bushels from August, Minnesota up 1.5 bushels, South Dakota down 1 bushel, Montana down 7 bushels, Washington down 5 bushels per acre, Idaho up 2 bushels per acre. Durham, you see the changes from the August report there for Durham. Okay, quarterly stocks. And again, wheat, 13 million above average trade gas, but 36 million below my estimate there. So I missed it by more on the wheat. The big clincher there is really estimating feed usage in the first quarter, because USDA oftentimes will assume feed usage that's more than twice what we end up doing for the year, and then the following 3 quarters they start adding it back in. So, but if you look at percent of final feed wheat that's in the first quarter, it's all over the place, making it a little bit of guessing game. The average trade was about 13 million less than where USDA came out, and that's basically inconsequential. Maybe a tad lower feed usage, but that's within sampling error. Soybeans at 342 million. That was 9 million less than what the average trade guess was. That means a little bit more residual use, whatever that is. USDA did change their soybean production estimate from last year, dropping it by 2 million, but that's pretty small. They actually lowered their corn production estimate from last year by a little over 1 million. Again, that's very, very small and inconsequential. So their stocks estimate coming in at 1.76 billion is 86 million, below 84 million below what the trade anticipated, and even more below what I anticipated. So what does that mean? That means that feed usage was much higher than what is anticipated by my estimates, about 61 million bushels higher than what USDA had it down for. And so if feed usage was larger in last year, then that would give that the market will assume it'll be higher for the new marketing year as well. And I include that in my balance sheets, which I'll show you here in a bit. If we look at on-farm quarterly grain stocks, this is what they are for corn. You can see on-farm numbers all year long have been at higher levels. We've been building more storage, and we were reluctant sellers off the farm this year. If we look at corn on farm where it's at, you know, South Dakota and Minnesota were the big increases, but also Iowa and Illinois with more corn on the farm September 1 as we're starting harvest. That means less open storage space. If we look at soybeans, again, on farm storage higher than in the past. If we look at where it's at, well, look again, Minnesota, Iowa, Illinois. So we're adding up those bushels on the farm, taking away available storage for the new crop that's coming. We look at wheat on farm. You see this dot over here for the new 24-25 marketing year on September 1st, markedly above where we've been in past years in on-farm storage. And you look at where it is now. South Dakota, 6 million less. North Dakota, 35 million less than a year ago. Minnesota, 4 million less. Illinois, 8 million higher overall. So less space there available. When you look at corn export sales continue to trail the pace needed to hit USDA's target by about 35, 40 million bushels. Now that can easily be made up, and I'm anticipating that it will because of the shorter Black Sea crop last year, a shorter crop expected in Argentina this next year, with acreage expected to be down 20 million plus or minus 5%. Excuse me, 20 million, 20% plus or minus 5 percentage points. And then it comes down to, okay, what does Brazil's production do? When we look at export inspections for the first 4 weeks of the marketing year, it's really been unusually high. Now, we had the 1 week where it really dipped down and that pulled us under, but USDA has a more aggressive export target this year. So if you look at the seasonal pace where we need to be to hit USDA's target, the first 4 weeks of the marketing year, actually 26 days, corn export inspections to date exceed that seasonal pace by about 7 million bushels. We were negative until today's export inspection report, and today's numbers took us positive. So we're going to be monitoring that. And I do expect, particularly in the last half of the marketing year, we're going to see our corn exports improve more than normal. You can see they normally are better in the last half, but I think we'll see more than that this year. Here's my balance sheet overall. And from today's stocks report, I basically increased feed usage. And then from that, I increased feed usage for the new marketing year in all three of my scenarios as well. So we don't know what USDA is going to do with production on October 11th, but this is what it does, keeping those same production numbers from September 12th. It now pulls my new crop ending stocks to 1.836 billion bushels, which is 12.2% stocks to use ratio. And again, I've said the market really doesn't care a whole lot until or unless that drops below 10% stocks to use ratio. But we're getting closer to that level. So that's why I said I don't see today's numbers as enough by themselves to justify sustaining a rally in corn, soybeans, or wheat. But it does eliminate some of the margin for error, and it does make the market pay more attention to dryness that we currently have in Brazil and in much of Argentina, while keeping track of what's happening in the Black Sea as well, because we've taken away some of the margin for error. And so that's a big reason we had the strength today. Overall, when we look at managed money, it has covered roughly half of its short positions, if not more, of its short positions in the corn market. When we look at soybean export sales versus the seasonal pace we need to be at the USDA's target, we're trailing it by about 135 million bushels. So a significant shortfall there. And when we look at actual export shipments, we're trailing the seasonal pace needed to hit USDA's target by, I think it's about 15 million bushels, 18, I'm sorry, I guess I have it there, 18 million bushels. Very close to last year's inspection pace right now, but that's below the seasonal pace that we need to be on with USDA's more aggressive export target for this next coming year. We continue to lose market share to Argentina and Brazil, and assuming they continue to produce and don't have any crop failures, I anticipate that pattern is going to continue. With Brazil planting more and more soybeans in this coming year, we're going to see Argentina grow more as well, probably about 10% more. Used cooking oil continues to come into the country. The California Air Resources Board is looking at capping soy oil and canola oil at 20% of feedstock for green diesel. And we see that continuing and being adopted by other states as well. There is a bill before Congress to try to eliminate the subsidies that come from RINs for any feedstock that is not domestically produced. So that would favor U.S. Soy oil, canola oil, etc. But that goes against what California is leading the way on individual states doing. But the bill in Congress right now, we still do not see it having enough support to pass. So at this point, we don't see any momentum for it becoming law anytime soon. Congressional efforts to limit subsidies to domestically grown feedstocks for U.S. biofuel production likely lack the sufficient support for passage, as I indicated below, based on what our sources are telling us. California's CARB board still expected to move forward with its limitations. If we look at soybeans, the only real change in the balance sheet from today's stocks is I increased residual use to 124 million bushels. That really doesn't change a whole lot. It's not really a market moving change in the balance sheet. The funds here too have cut a little bit more than half of their net short positions. If you look at the wheat balance sheet, I did cut feed usage down to 102 million bushels, down 8 million bushels based on the quarterly stocks reports, and also making adjustments for production, cutting production by 11 million bushels. So that made the balance sheets kind of work out to do that. No other significant changes. Hard red winter wheat continues to be the class that's really oversupplied right now. China, of course, has the biggest portion. More than half of the world's stocks are in China. World stocks balance sheet supplies in the major exporting countries are tight. Now, the global cash wheat prices are basically set in the Black Sea. And those Black Sea prices have been consistently trading $216 to $218 per metric ton. Those are surplus condition types of prices. Meanwhile, we're seeing supplies in Russia really tighten up. We think that we're going to see USDA tighten up those supplies some more. And it is very dry, which I can't remember if I showed you that graphic. I want to quickly see if I can, I still got that coming. It's very dry in Russia and winter wheat belt. And so their crop, which really you want established by the 15th of October, you want it established by then. Much of it's just in the dust, and they're planting in the dust. And so their winters tend to be harsher and set in sooner. And so that really raises a risk. It doesn't mean that you can't get moisture and still get a big crop, but it really increases the risks for their crop. And so the question is, at what point will the Russian government, because the food inflation's already started there, at what point will it start restricting exports? And what the word is we're getting is that exporters are really rushing to export as much as possible because they believe if those export quotas are handed out, they will be handed out based on how much you've exported already. So the exporter that's exported the most will get the largest quotas going forward, even though those quotas will all be smaller. And so they're pushing a lot out the door now. But once that restriction happens, if it happens, then we would anticipate that'll focus the market on how tight supplies are among the other world major exporters. And that is what the futures market has been trading that has fueled the short covering rally in part. Some of the short covering's been this larger commodity big picture type of thing that I've been talking to you about. But we think that's what would sustain the rally. Eventually the world's cash market and the futures market are going to have to come together. But I've kind of given you the parameters that we're monitoring on that. And I particularly think we'll see exports pick up in the last half of the marketing year as that happens. But you can see it's been one of the driest falls thus far over the last 4 decades in Russia's winter wheat belt. Wet to the north, wet to the south, and dry right in the middle in those core production areas. Chicago wheat, the funds have covered probably close to 70% of their short positions. Kansas City wheat, it's probably very similar to that as well. Okay, take home points from the day, and then you can put your questions in the Q&A box to the right. And I do want to say before I forget that if you're interested in downloading this presentation, we do have it there in the resources section for you to download a PDF of the report. Take home points today, corn feed usage did exceed expectations as cheap prices incentivized keeping animals on feed longer, and we've definitely seen that. There were 270 million bushels more corn, soybeans, and wheat in on-farm storage on September 1st this year versus the previous year, and that's going to make less space available then, excuse me, for the big harvest coming. Storage of this year's fall crops will be a problem to varying degrees across the Midwest in different areas. The small grain summary held very few surprises for the market. Commodity deflation pressures are really easing in the near term, and I think in the long term as well. Keep your eyes on this port strike stock starting October 1st. That is primarily impacting container freight. It will also impact meat shipments, which are mostly in container as well, both exports and imports. Most of our meat exports go out the West Coast where the strike is not at this point occurring. But we do export quite a bit of particularly pork and poultry into the Caribbean area and that area of the world, which will be impacted. We also see quite a few imports come in via these ports that are going to be on strike of meat. But corn, soybeans, wheat, there are some specialty shipments in containers that will be impacted, but bulk are not currently expected to be impacted, excuse me. So with that, I'm going to wrap things up and get a drink of water here, and then we'll address your questions. I already kind of addressed the first two questions on spending and the impact on agriculture, but we can start with some of the other questions that are there.
Okay, thanks, Arlan. The first question we have is the market underestimating the demand?
Originally, I didn't think so on corn. I do think that perhaps it is on corn now, that although my confidence isn't high on that, because it's based on a lot of variables. I do expect that with a shorter Black Sea crop last year, Argentina planting less acreage of corn in the coming growing season, that we'll probably see stronger demand going forward. I think with this report and the higher stocks, I think USDA is going to get caught up, and the market is getting caught up today, so to speak, on pricing in more feed demand. So that is now priced in. But that has been a tendency. Cheap corn does buy demand. We've seen that with ethanol. We're seeing that with feed usage. The question is, how well can we hold up the export demand to Mexico? And I think that's a key question to be answered yet going forward. On soybeans, I think USDA has put in too much demand. I think it's the other way around. I think the market is pricing in too much demand as a result as well. On wheat, my bias is that they're not pricing in enough demand, but I don't think it's a big market factor at this point. I do expect wheat exports to improve in the last half of the marketing year, though, and we're already doing pretty well on exports.
Okay, the next one we have is during the 23-24 season, the market once or twice thought that the corn carryout could be over 2 billion bushels. Now it is 1.76. Are you surprised? How can the market handle it regarding the 2024-25 crop besides the lower carryout?
Yeah, and that's a related question, and it's a good question. And overall, as we look at it, the question, are you surprised? Yeah, I am a little bit, but it's because of cheap prices over this last year that fell even faster than what I anticipated, really did stimulate demand. For example, when you look at carcass weights, we had record carcass weights for cattle, record carcass weights at time for hogs, because the feeding economics with the cheap corn incentivized feeding to heavier weights. and the ethanol margins were boosted as well, although I was a little less surprised by that. So that was a product of the market getting cheap enough to increase demand. So the question is, will that happen in the 24-25? And it comes down to how cheap do we want it to get. If we take prices cheaper, then yes, we can build that demand, but it may take some significant pain to do that. So there is a trade-off for that.
All right, the next one is, do you anticipate the farmer will sell more corn soy compared to last year, or will they keep their corn soy and their beans?
Excellent question. So far, the farmer is very slow to sell corn and soybeans. Now, there's two parts to the answer to this question. The first of all, once we harvest a crop, we've got to get it into the bin, whether it be on farm until it's full and in commercial storage, and both are going to fill up overall, and then we're going to end up piling on the ground. And some of those bushels are going to get forced onto the marketplace. The farmer is financially not as healthy. He's probably financially in as bad a shape as he's been in a number of years. And we're nowhere close to what we were in the mid-1980s, and I hope we never get back to that point again. But for a lot of younger farmers out there, they've never seen times this tough. And so they're shopping around for cheaper insurance. They're shopping around for cheaper interest rates. They're shopping around to save, $50 here and there, and shopping around for fertilizer get lower. And I anticipate that they may be watching the fertilizer rates going on this fall for ahead of next year's planting season. But they're doing so in a way to try to avoid having to sell grain, and because they don't want to accept the current prices, and in some cases they may pay more interest just to avoid selling at these prices if they can avoid doing so. So I think the farmer will sell what he has to sell via paying the bills and via storage problems, but otherwise is going to delay selling as long as possible. I'm not saying that that's the recommended way to go. I'm saying that's the behavior that I anticipate seeing this year.
I think that covers all of our questions, Arlan.
All right, thank you very much. I look forward to our next webinar on October 11th. Is just double checking the calendar there, so October 11th. And on that webinar, we should have, of course, we'll have the results of our survey. We'll have the results of USDA's updated production estimates. That should give us a good handle on what we had in the way of losses from Helene, from wind damage, as well as late season yield loss from the dryness as well. We should have a much better handle on the size of the crop, and maybe more significantly, a much better handle on the weather pattern in Brazil going forward and what we anticipate the market trading. So I look forward to seeing you on October 11th, just 11 days from now. And until then, be safe. Thank you.